Hey, good morning, everyone. Excuse me. Good morning, everyone. Eric Walters, Managing Partner at Summit Hill Wealth Management. Thanks for joining us for our webinar to talk about market volatility and rising interest rates. We think this is an opportunity for investors to take a step back and look carefully at their portfolios and take appropriate action rather than reaction. I want to thank you for taking some time to share with us, and I know you may have questions. So at the bottom of the bar that you'll be able to see, there is a Q&A section, and there also is a chat. I'll be monitoring that throughout the discussion. And if you have questions, if you want me to pause, please let me do that, and let me know what your questions are. And then also, as we go along, if you'd like a copy of these materials, I frequently get asked hey, share slides. Can I see that chart? That was really useful. I'm happy to do that. And the, excuse me, the information here is you can email us at info@summithillwealth.com. So we'll get started. The three things I want to talk about today are market volatility. I think it's on everyone's mind. There's a lot of causes for that. I'd like to focus in specifically on interest rates. That's been getting some news lately with the Federal Reserve raising interest rates. I actually think that's one of the most important things for investors to pay attention to right now, and I'll explain why. And then finally, we'll talk about the implications of volatility and rising interest rates for investors. If you're not familiar with Summit Hill Wealth Management, we are a boutique wealth management firm. We help manage the finances of successful families. We help them create a plan so they can enjoy their lifestyle to help preserve and grow their assets. We help them invest. We coordinate with the other wealth advisors. We help them protect themselves, their assets, and their loved ones. And then we also help communicate and prepare their children to manage family assets. So if that's something that you feel like you'd like to get to know about, please, again, email us at info@summithillwealth.com. Many of you may have attended our webinar in January where we talked about our outlook for the stock market for 2020. This is what we shared then, that most global economies are in mid-cycle. This provides a positive backdrop to the market, but we think the kind of reality of slowing growth. We'll talk about that in a minute. We were expecting higher volatility, and we have gotten it. We talked about how inflation may moderate but remain at elevated levels. We thought higher interest rates can be a headwind. We still think that, and that high portfolio diversification is warranted. So in some ways, many of the things that we've been expecting have been happening and kind of confirmed, and we'll elaborate on that. I know we talked about market volatility, but I always like to take a step back and provide context for where we are in the economic cycle. And the reason why we do this is that the economic cycle is one of the most important things that drives stock, bond, currency, and commodity markets. So it's helpful to take a step back and see where we are in kind of the economic cycle. And this is a chart that many of our clients are familiar with. It just basically looks at kind of the different cycles of an economy. There's an early cycle where economies are coming out of recession. There's mid-cycle where growth and profits usually peak and then start to kind of move down the cycle. There's a late cycle where growth is, constricting even more. Credit is usually tightening. Things are kind of getting, a little concerning, and then there's a recession. And so when we think about where are we in this cycle, we are in the mid-cycle. And for those of us that joined, again, in our January webinar, many of these, kind of bubbles representing developed economies were earlier in this mid-cycle. So we think, just in 2 months, we've kind of moved farther along in the economic cycle. And really, what does this mean, being in the mid-cycle? It means that growth is still positive, that consumers and corporations are still growing. There's kind of a good outlook. But you may notice kind of the shape of this curve kind of trends down. It doesn't mean that we're suddenly heading into negative territory. It just means that the rate of growth, meaning how quickly firms are growing, is going negative. And that just means that growth will slow. And the implications are that we'll start to see more disappointing earnings reports from companies. We'll start to hear about how retail sales are starting to moderate, industrial production is starting to moderate, and the kind of the commentators will be looking for a villain when they talk about this. They'll look around and they'll probably point to the war in Ukraine. They may point to presidential policies. They'll certainly talk about the Federal Reserve, but a lot of this is just happening on its normal growth cycle. It's normal, for kind of biological entities to kind of go through a growth cycle, but the same thing happens with economic cycles. And so growth can't continue to the moon. As we've gone through the early cycles, things have gotten more expensive. Everyone's kind of noticed that. Consumers are reacting normally and making alternative choices. This is one of the things that will drive a lot of companies into slower growth. For quite a while in the early cycle, companies could kind of charge whatever they wanted. Now consumers are becoming more discerning. They're being thoughtful about that road trip. They may go to a less expensive restaurant. They may defer a purchase. And that just means that companies are going to have to, kind of enter back into the competitive fray. One thing that's unique about this mid-cycle is that we are experiencing more inflationary pressures earlier than we normally would. Now, everything about this expansion is unique because it's coming after COVID. But you may notice that one of the hallmarks of the late cycle is that policy is contractionary, meaning interest rates are going up. Kind of the policymakers are trying to rein in inflation, usually in a later cycle. But now that's happening earlier because inflation has kind of caught the Federal Reserve and other central bankers by surprise. So that's one unique thing about this. But in general, we've got a lot of strengths that we should pay attention to, and we've outlined them here. When we think about kind of the balance of strengths and maybe challenges, there's a global expansion after COVID. We just saw that the majority of developed and even emerging economies are kind of coming out of COVID. Restrictions are lifting. We have strong consumer balance sheets, strong corporate balance sheets. We do have high corporate profits, although they may, moderate, but right now they are high. The supply chain problems that we've noticed are easing. Many of this labor shortages are easing, and we've got favorable credit conditions. So, we've got a lot good that's going on. Before we get to kind of market volatility and talk about the war in Ukraine, I think it's important to take a step back and just provide some context for this. Now, there are important challenges that we are paying attention to. The war in Ukraine is kind of chief among them. Now, historically, the stock market's actually been pretty resilient through conflicts like this. But the longer the war in Ukraine goes on, the more risks it presents, especially in energy prices. So we talked about higher commodity prices. You may or may not know that Ukraine actually is a fairly large exporter of a number of grains. A number of commodities are, kind of come out of Ukraine. And so we've already seen an increase in those commodity prices. And the longer this goes on, it risks not only higher prices for those commodities, but also kind of snarling of supply chains around that area. So, of course, European countries are most affected by this. A good example is higher gas prices throughout European countries as supplies from Russia, are being interrupted. So the war in Ukraine is certainly a challenge. Related high commodity prices. Persistently higher inflation is certainly a risk because that will push central bankers to raise interest rates quickly. You may already know the central bank in the US, Federal Reserve, raised interest rates last week, and they have been talking about raising them not only consistently, but also at higher intervals. So rather than a quarter of a point, potentially a half a point. So historically, there's a point when interest rates get high enough that it causes a recession. We'll talk more about that. But that's certainly a risk. And then the European exposure to war and sanctions do create a lot of economic pressure. So we don't know how long the war will go on. We have to be kind of humble and just realize, it's a terrible situation and it may continue to affect things for a while. At the same point, we don't want to only focus on challenges. It's natural, I think it's part of our, kind of our mental models to focus on the negatives, right? We can say, hey, inflation is high. We've got a war going on. Hey, and just basically think about kind of the challenge category. But we don't want to lose sight of the fact that there's a lot of strengths in the kind of good category. So we'll talk about that a little bit more, but we don't want to lose sight of the fact that the markets have been volatile. This is a chart, that just shows kind of performance year to date. Gold is up about 6.5%. The purple here, it's a little hard to see, is AGG. These are bonds. This is U.S. Aggregate bond. They're down about 5.5%, kind of consistently trending lower as interest rates have been, moving up. The SPY here is the S&P 500. You can see at one point it was down probably at the lowest point, maybe 12% year to date. It's since moved up quite a lot over the last few days, as has the EFA, which is international stocks. They were down about 15% year to date and moved up notably. So, this is just a snapshot of volatility, but what's interesting is just how quickly markets have moved up over the last 9 days. It's actually been a pretty impressive rally. And this is, a good reminder for investors that at the point you start to probably think about panicking, might have been early last week, can be the beginning of actually things turning around. I had a conversation with a client last week, just talking about the volatility and how uncomfortable it is to see your portfolio go down. And, I pointed this out that, often the markets can reverse quickly. And this is a great example. This kind of reversal from -12, -15, up by about 10 percentage points. That's a classic example of how timing the markets is incredibly difficult. Now, my speculation is that the markets may be anticipating a change in the war in Ukraine. That would not be a surprise. It also may be the markets are responding to the Federal Reserve commentary. That may seem kind of counterintuitive, that the markets are viewing higher interest rates as somewhat positive. But remember, markets hate uncertainty. And the fact that the Federal Reserve came out and said, hey, this is our view of the economy, we think it's quite strong, if this is our plan to deal with inflation, actually gives the stock market some comfort. I know that may seem odd, but it just kind of says, we're glad the Federal Reserve is paying attention. We're glad that they are, kind of on, paying attention, and they've got a game plan, is kind of what the stock market is kind of reassured by. And the stock market knows that if interest rates get too high, it'll cause a recession, but that's usually down a bit. So the stock market, I think, is looking usually 9 or 12 months ahead and basically saying, hey, we're glad the Federal Reserve has a plan for this. Let's talk about the war in Ukraine. It's a terrible situation. I won't comment, on the political ramifications or my personal views on it, except to say that there are, by a lot of estimates, 10 million people who have been displaced from their homes, many of those into neighboring Poland. I'll just say as a firm, we want to do everything we can. We've decided to support the Red Cross and their efforts in supporting people in Ukraine. And I just would encourage you, as you think about events, particularly if you're worried about the market and portfolio, to also think about how you might be able to support people there. But we chose the Red Cross because they're providing kind of boots on the ground. They have a great track record. They're providing food, clothing, blankets, bedding, sanitation supplies. And, there's a growing humanitarian crisis for people that are in Ukraine, that are trapped within those cities, and then, of course, refugees. So I just encourage you to think about that. There's other great organizations like Doctors Without Borders, but just encourage you to think about that. So when we think about the war in Ukraine, again, it may seem cold-hearted, but our topic is just thinking about investing. When we think about it, it's really going to affect the U.S. more, it'll affect the Europe area more than the U.S. And this is just natural because Europe is so close to Ukraine, because so many of their imports and exports are affected by these supply chains. A good example is gasoline, natural gas, diesel. We have clients that are in France, and they've talked about how their cost of gas has already doubled. You may be familiar with the pipeline that was going to supply natural gas from Russia to Germany. It's been canceled. That has major implications for energy markets in Europe, food markets in Europe. But a lot of those same implications are not present in the US. Our lumber isn't sourced from Russia. Our natural gas is in general produced at home. Our food is usually not affected. So we are affected by prices as they go up, but the actual physical goods are not that affected. So it's good news, bad news, difficult certainly for people in Europe and companies there. But within the US, we're affected by those prices, not so much by the actual things themselves. You can see some of the risks there in terms of higher input prices, supply chain, and then shaken investment. Certainly only going to continue as long as a war goes on. And then also it reorders the geopolitical landscape. That has some, very long-term and serious implications, in terms of allies. We've already talked about, the potential impact of sanctions, but just the reordering and just kind of the re-energizing, I think, of the NATO alliance could have some major implications for the economies in Europe. When we think about conflict, we did release a blog post recently and just talked about how stock markets have performed during periods of armed conflict. This goes back to World War II, actually, the Pearl Harbor attack. I won't go through all the data on this. Again, if you want a copy of the slides, email us at info@Summit Hill Wealth. But when you look at how the S&P have done, in one day, but then also kind of total drawdown, what's surprising is that you can look at some, fairly major military conflicts, including the Cuban Missile Crisis, and the impact on the stock market's fairly muted. And you may be, kind of surprised by this. But in general, the stock market's looking at how anything will affect consumer spending, corporate spending, government spending, interest rates. That's kind of some of the main things that the stock market looks at. And for most conflicts, unless it's literally a world war, there's not going to be a huge change in there. Commodity prices can go up, inflation can certainly go up. But the stock market, will generally say majority of people in the world, the majority of companies are not directly affected. And so it kind of prices that in. And then when you look at how quickly the market bottomed and then kind of number of days to recover, you can see on the bottom here, usually within, kind of a period of months, actually, the stock market kind of hits bottom and then starts to recover. So in my conversations with clients, that's why I've told them, that usually the outbreak of, military conflict is not a time to try to time the market, either to try to get more aggressive or get out of stocks. It just doesn't work. So I think this provides a lot of comfort that even if the war in Ukraine goes on for quite a long time, stock markets have dealt with kind of longer term conflicts for quite a while. You think about Vietnam War, for example. You think about the Yom Kippur and Middle Eastern conflicts. The markets have dealt with longer term, multi-month and even multi-year conflicts pretty successfully. So from an investment standpoint, I don't think the war in Ukraine should affect portfolios or affect our thoughts about portfolios. Maybe like something else. We've already talked about commodity prices. If you've been paying attention at the pump, gas prices have already moved up. You can see this is Brent prices. They spiked as high as, I think it's 122, 120, 123 in terms of closing prices. They've come down since then, but they're significantly elevated from early 2021. This is, kind of having kind of knock-on effects throughout global supply chains. Much of the global economy is affected by oil, not only in terms of energy and supplies, but also in terms of inputs to plastics. So we'll have to see kind of where it is. I like to point out that stock markets kind of incorporate this data. So as much as we may, focus on crude, it's important to realize that this information is priced in to stock markets, and it's also kind of outlook is priced into stock markets. So everything we know about commodity prices, other investors know and are pricing in, and then also kind of the outlook for commodity prices is priced into stock markets. So if we go back to that prior slide that showed that year-to-date stocks are down about, give or take, kind of 5 or 6%. That's actually quite positive because it's the stock market basically saying we know everything about, not only energy prices, but also about inflation, and we still don't think it's time for a crash. And so that's, I think, positive. You can see the data here on CPI consistently high. And I think this is showing the Federal Reserve that they probably made some mistakes last year. I think, Federal Reserve officials have kind of indicated they probably should have raised interest rates, maybe last fall. And, rather than been so dovish or so gentle about talking about interest rate increases, they could have said, look, the economy is doing great, companies are doing great, consumers are doing great, we're going to start raising interest rates and everything's fine. But instead what they said was that they would hold down interest rates, they'd be extremely careful, they'd raise rates very, very slowly and sent this, very, very gentle message to the stock market. And now they're kind of having to walk that back. and say, well, we're going to be tough on interest rates, or excuse me, we're going to be tough on inflation. We may raise it, half a percentage point. We may be aggressive. And so, they're human. And, just in general, history shows that central banks have a great track record of making mistakes. A lot of people view the Federal Reserve as kind of having a crystal ball or, always getting it right. But actually, central banks have done a great job making consistent blunders. And, that's okay. As an investor, particularly a long-term investor, we don't have to rely on the central bank to try to rescue us and just kind of anticipate that they'll make mistakes. The data on employment is fantastic. I like to show this to clients just to show how quickly unemployment has come down. So this is the current unemployment rate. And this is just about at the level we were at before COVID struck. And really, what's the takeaway here? The majority of people around the US who want a job and capable of working are working. So that's very, very good news for consumer spending. So as much as, again, we want to focus on the negative, this is incredibly positive. And just look at the personal spending numbers there. They're off the charts. And you get these, dips that'll happen, and that creates headlines. But in general, people are anxious to spend. We were just lucky enough to come back from a spring break trip. People are spending money. People are lining up at restaurants. Places we tried to go on vacation were, kind of booked out weeks in advance. We talked to people who said that it was kind of the strongest demand that they'd seen for their services. So this is good news. This is, again, that kind of underlying strength within global economies. So again, as much as inflation, interest rates, war in Ukraine are concerned, yes, it's a concern, but we also need to look at just how many people are employed and the money they're spending. And that's really positive. So I want to pivot and talk about interest rates because I think this will be kind of one of the dominant themes that investors should pay attention to always, but particularly for the rest of the year. This is something called the Treasury yield curve. And this may not be something that you've seen before, unless you're a finance geek like me. But this is just showing the interest rates that are available right now if you decide to lend money to the US Treasury at different maturities. So for example, at the 3-month, it's about 0.5%. And then you can go get down to 10-year, it's a little below 2.5, as is data as of yesterday. And the 30-year is higher. And so it makes sense that if you are going to lend money to an entity, be that a person or a local municipality or the US government, you expect to be paid more over time than you would if you were to only lend it for a short period of time. Now, you may notice that the shape of this yield curve has this kind of flattish area right here from basically kind of 2 to 3 years on to 10 years. And, the shape of the yield curve is actually incredibly important, and it tells us a lot about what's happening in markets globally. And there are, a number of kind of investment strategists who will say that the shape of the yield curve is actually one of the most important things at all. Historically, if the yield curve is very, very steep, meaning, it's low at the kind of near end of maturity, and it's very, very high at the high end of maturity, that's very bullish for the stock market and the economy. It means there's a lot of demand, for money out on the curve, and to kind of supply that demand, interest rates are higher. If the interest rate starts to get more flat, as we've actually seen here, that's actually a kind of a concern, because what that means is that investors are not as willing to lend money longer periods, right? 5, 10, 15 years, so forth. And there's actually, kind of more demand on the shorter end. And what happens is these shorter term rates start to move up. So in a kind of a steep environment, shorter term rates would be lower and longer term rates would be higher. But what's happened here is you can see these kind of 2-year, 3, 5, 10-year have kind of bumped up. And what that means is that investors are actually showing some concern. And historically, if the interest rates between shorter term, more like 2-year, and 10-year become flat and even inverted, that usually signals a recession is coming. And I know, it's kind of unusual, but there actually is a recession indicator that has kind of a perfect track record. And it's this difference between the 2-year interest rate and the 10-year. So just to go back to our rate here, if the 2-year actually goes higher than the 10-year, that's called a negative interest rate spread. And you can view this here on this chart. This is the spread between the 2-year and the 10-year treasury. And what's interesting is that this indicator has a perfect track record of predicting the last 9 economic contractions. So I won't go through each one here, but going back quite a ways, when this spread became negative, meaning 2-year rates were higher than the 10-year rates, within about 6 to 18 months, there was a recession. And so there's been a lot of academic debate about this. It kind of makes sense that it's happened. Now, what's interesting is it actually happened in August of 2019 before COVID. Now, it only happened intraday, meaning within during the day, and then it kind of popped out. And there's some academic debate about whether intraday, negative yield spreads are still a valid indicator. And it's hard to know if it was coincidence that it happened and then COVID happened. I'm not sure if the stock market was actually thinking about COVID. I don't know. But what's important for us right now is this spread has gone, more negative here. And so it's still in positive territory, but it's in that zone where, you kind of think, hey, we're getting a little close here. And if just visually, if you look at the current yield spread, you can see that it's not too far off between the 2 and the 10. So this is the bond market basically looking forward and saying, we're concerned that there might be a recession. And why may the bond market be worried about this? It's the rise in interest rates. Increasing interest rates generally at some point cause a recession. So, the bond market may be worried that inflation is so high, it'll force the Federal Reserve to raise interest rates to a level that will cause a recession. That's a possibility. The bond market may also be worried about the war in Ukraine that would continue on, kind of then leading on to inflation and then higher interest rates. But either way, we've got kind of a recession kind of watch, I would call it. We're not at the level where it's almost negative, and it may make sense to start lining up on stocks, but it's something that we're watching pretty carefully. So again, to go back to that strength weaknesses kind of column, we've got a lot of things that are strong. We are aware of the fact that we're on kind of this downward slope. And, history can say that we can go into this later stage and recession somewhat quickly. So we just want to be watchful and just kind of pay attention to the fact that, we may enter a recession within, months, maybe a couple of years. It's hard to know. There have been periods in the past where this spread has been, kind of low and then kind of continued up and been fine. So it's perfectly possible that if war in Ukraine resolves, if inflation starts to moderate and the Federal Reserve has, a more gentle path forward, that this spread could kind of continue back up and maybe quite a while until we have a recession. So we'll have to pay attention to it. So what can investors do right now? The future is unknowable. Predictions are difficult to trust, but there are a number of steps that investors can take, and we'll go through each one of these. And so, I think it's important just to realize there's a number of steps that are useful in a market like this. The first one is focus on your own financial plan. In a market like this, I think it's the knee-jerk reaction is to think the market is down, my portfolio values are down, I'm in trouble. I may not be able to retire, I may not be able to enjoy retirement. And this kind of decline in my portfolio value is a direct threat to my financial health. And, if you check your portfolios every day, I'd encourage you not to do that. It just kind of increases that stress. But a financial plan is really useful because it basically looks at your current lifestyle expenses and projects those forward into the future along with your portfolio and all your other resources. And this is a screenshot from a tool that we use with clients to kind of project forward what would happen, kind of with their portfolio, both in a good market and a down market. And you can see here it says below average market. And so what we do here is we model out clients' future lifestyle and future portfolio in both good markets and down markets in 1,000 different scenarios. And the value of this is that in those 1,000 scenarios, there are a lot of market crashes. There are periods where inflation is higher than anticipated. There's a lot of simulated military conflict. And you can see what we want to look at is how does the portfolio perform in this down market? And we want to count out of those 1,000 different simulations, how many of them are successful? So if you're a client, you've probably already gone through this. If we haven't looked at this in a while and you'd like to look at it, please let us know. And if you're not a client, and you want this kind of peace of mind that you and your loved ones and your lifestyle and your portfolio can make it through, please let us know. Again, email us at info@summithill.wealth. But that's the value, because I think it helps you know we've already looked at down markets. We've already anticipated market crashes, and we're going to be okay. And what that does is it gives you the ability to look forward to the long term, to basically say the stocks in my portfolio are the ones that grow, and they also provide a lot of volatility, but things are going to be okay. We've kind of modeled this forward. So first, create a financial plan. If you don't have one, let us know, and just kind of review it. The second thing is ensure your risk tolerance and your goals are in sync. We talk about this with clients all the time. We want to break a portfolio into different components to think about what's the purpose of that part of the portfolio. So for example, if you are going to be in retirement and you've got expenses coming up in the next 2 years, maybe you have a nice trip that you're looking forward to, maybe you're going to be changing, homes, those assets that are going to pay for expenses over the next 2 years should be in very safe investments. That's cash, that's bonds, that's managed futures. And so this is lower risk and lower projected returns, right? So in this low level, I always like to think of it as a pyramid. We should make sure that we have, enough assets to get us through at least 2 years, and preferably in, cash and very safe investments. And what that does for you and for clients is it allows you to go through market volatility and say, it's not going to affect my lifestyle for at least the next 2 years. That's fine. And it lets you take a step back emotionally from market declines and say, I'm going to be okay. Now, there's an intermediate place here where it's just kind of assets for lifestyle expenses and goals within the next 2 to 8 years. And this should be in kind of moderate investments. So again, this should be bonds. Real estate is a great tool here. Hedge funds can do a great job. So we're taking some risk here, of volatility and fluctuations, but we're also expecting, higher returns. And so again, we're kind of looking out kind of 2 to 8 years. For a majority of our clients, a good part of the portfolio here is bonds. And so for clients, I always like to calculate how many years of expenses we have in cash and bonds. And for many clients, that's anywhere between 5 and 10 years of expenses is in cash and bonds. And so that means that they don't really need the stock market to grow for, kind of 5 to 10 years from now. And so that means, year to date negative performance of negative 6%, it doesn't really affect them. But eventually we do want portfolios to grow. And so there's a part of our portfolio that we'll have in stocks, private equity, hedge. These investments are higher risk. They do fluctuate, but the reward we get for the fluctuation is growth. And so we're kind of segmenting a part of the portfolio. We know it's going to be volatile, but it's going to grow our assets for the long term. And usually it's for that kind of 5 to 8 years from now. That's when we want the growth to happen. And if we look backwards 5 to 8 years ago, the stock market has certainly performed well. By kind of any measure, the stock market has grown very well from 8 to 10 years ago. And even if you look back 15 years ago, that before the 2008 crash, before the 2012 European zone, kind of correction, before the 2018 kind of taper tantrum and market correction, and before COVID, we've had at least 4 major market declines in the last 15 years, but the stock market is up considerably over that time period. So that's just an example looking backwards. How has this strategy worked? It's actually worked pretty well. And if you look backwards decades, this kind of approach has worked really well in good and bad markets. So if you're thinking about your portfolio, I'd encourage you to think about, assets over, kind of 2 years, 2 to 8 years, and then beyond. And you can kind of layer your portfolio appropriately so that 1, you get the growth you need. 2, you have cash and safe assets for the lifestyle needs you have now and in the near term future. And then 3, it gives you peace of mind to look at the stock market volatility and say, that's okay. I'm a long-term investor. I don't really need it to perform over 1 or 2 weeks. I need it to perform over a decade. The last thing we'll talk about, or I'm sorry, not the last thing, there's one more here, is focus on the long term. I've already mentioned that. Be humble and prepare for surprises. I think one thing that consistently trips up investors is taking recent experience in the stock or bond market and projecting it forward. So this happens in good periods, certainly like 2021. That was a great year. Things were, doing very well. Stocks were up anywhere between 20 and 30%. Real estate was up 45. Kind of the good times were on a roll. And many investors, I think, just kind of say, oh, I'm sure it's always going to be like that, and things are great, and everything's fantastic. And then we get, the war in Ukraine, we get rising interest rates, and we get market volatility. And then what investors tend to do is project that volatility forward and say, well, I'm sure stocks are going to continue to go down. It's so clear. It's easy to see that stocks are going to keep going down. And that's very normal for people just to take what just happened and project it forward. But it's a mistake and it's a trap. Like we just saw, the stock market was down 12 to 15% early last week and is already up about 10% from there. So markets can turn very, very quickly, both negative and positive. And so just be careful assuming that it's clear what's going to happen in the stock market. That's not always the case. And then also be clear about falling in love or hating a particular asset. Some investors right now are hating stocks. They don't like the volatility. Others may be concerned about bonds. But if we rewind last year, stocks were the stars, and bonds were, who would care about that? If we rewind, just about 8 years of, commodities like oil and gas were getting no love. Gold was hated. Actually up until, just about 6 months ago, gold was completely hated. So investors go through, these kind of emotional cycles with assets. And I always say, if you are well diversified, there should be a part of your portfolio that is completely underperforming and that you hate. If there's not a part of your portfolio that you think is a dog and you don't like and you wish you could sell, you're probably not diversified enough. And a couple of years ago, that would have been value stocks, it would have been commodities, it would have been gold, it would have been bonds. And right now, those asset classes are stocks and bonds, and everyone's trying to get exposure to commodities and gold. So just be careful about those emotional, swings that we have. And then also, I hear a lot of people talk about the stock market in terms of kind of checkers. They think, well, interest rates are going up, therefore it's bad for bonds, or interest rates are going up, therefore we're going to have a recession. And really, the stock market's really playing chess. For example, the stock market knows that rising interest rates eventually cause a recession, but the stock market also knows that rising interest rates usually only happen because the economy is strong and there's demand for things and creating inflation. So the market is kind of weighing a number of variables simultaneously. And I encourage people to be careful kind of playing checkers with kind of simplistic assumptions going forward. A good example of that is this chart. It shows the number one performing developed market in a given year. And so, for example, in 2021, the best developed equity market was Austria. And, I'll give you $1,000 if you had predicted that in January of 2021. And how many times has the US been the top performing, market amongst all the developed markets? Actually, just once, going back to 2002. So what does this mean? Prediction is incredibly hard. Two, there's a lot of very strongly performing equity markets around the world. When you look at kind of what these numbers are, plus 30, plus 40, plus 20, plus 50, there's a lot of local markets that actually do really, really well. And it's better as an investor, I think, to own them than to try to say, oh, I like China, or I like Hong Kong, or I think Canada looks hot. I mean, I don't see any evidence that investment approach really works well. And this also allows you to benefit and partner with millions of investors around the world rather than try to fight them. If you're trying to outsmart all the investors in the world, you're really pitting yourself against millions of brains and millions of people's kind of experience and reasoning. That's a tough battle to win. But if you basically say, hey, I'd like to invest alongside these investors and let them, kind of parse information with me, then you're partnering with all those brains. So good idea to remain diversified and avoid trying to outthink them. And most people try to outthink other investors by timing markets. They say, now's a good time to get in, now's the time to get out. And I think that's a terrible idea. So when we think about our allocations, there are some things investors can do right now. The message is not just sit on your portfolio, everything's fine, just hold on. In general, that's pretty good advice, but in volatile markets, there are things we can do. And under stocks, it's a good time to rebalance. If you are overweight technology stocks and growth stocks, I work with a lot of clients that have a lot of exposure. It's not a bad time to rebalance. The market is kind of coming back to us here, and the market may continue to come back to us if the war in Ukraine resolves. It's not a bad time to rebalance. If you've got shares that are down quite a lot, you may actually thinking about selling them now because you'll pay a lot less capital gains and you can rebalance into a diversified portfolio that should give you better risk return characteristics going forward. Meaning, if you're heavily into one stock, you have a lot of risk of bad news of that one stock. If you sell now, you'll pay less in capital gains, rebalance into the portfolio you'd like. But particularly in stocks, a well-diversified portfolio will recover, but it'll remove some of that single stock risk. I also encourage people to embrace the unloved. We've been talking about international stocks with clients for quite a while. They certainly are unloved. As of last week, they were down negative 15%. They recovered quite a lot. But if you're a long-term investor, this is a great example of not looking at headlines to make an allocation, but looking at valuations. International stocks are incredibly cheap. They offer, some of the best projected returns among different types of stocks. So don't hesitate to think about international stocks. We already talked about working with, not against investors. Don't try to time the market. Let all the investors kind of around you kind of parse information with you. And then finally, don't abandon stocks just as you think about inflation. They're an excellent inflation hedge. In fact, when we look at inflation data, much of the data is reflecting prices that companies are charging for their goods, prices that have gone up with results of higher input prices and commodities. So higher inflation kind of shows that companies are already able to pass along inflation, and you want to own those things. You want to own things that not only are supposed to make a profit for you, but also can kind of pass along higher input prices. For bonds, with higher interest rates, good idea to shorten your maturity, look for managers with a good track record and rising interest rates, and avoid dumping bonds. Right now, I get a lot of questions about why should we even be in bonds if interest rates are going to go up and bonds may experience some, somewhat negative returns. The reason why is that we don't know when we're going to go into a recession. And the value of bonds is in a recession, the value of the bonds will go up. And so again, you don't want to time the stock market. You also don't want to time the bond market. You don't want to sell out of bonds now and kind of tell yourself, oh, when there's a recession, then I'll, get back into bonds. You never know when a recession is going to happen. And so bonds are our safe money, even if they're kind of taking a pounding right now, they're down about 5%. Still, they do pretty well. And if you shorten your maturity, you'll have less exposure to rising interest rates. We've talked about diversifiers. We talk to our clients and work with them about their real estate exposure, managed futures, private equity, and hedge. We think this is a great way to move beyond the standard kind of stock bond portfolio and help protect and grow portfolios in a unique way. So I want to be thoughtful about time here and just pause. If you have a question, if you have something that you want to go over, please go ahead and type it in underneath. There should be a little bar. You can type in the chat or the Q&A. I'll pause here and just see if there's any questions that anybody has before we wrap up. Not seeing any. So, kind of the takeaway, I think, is for investors to, again, kind of focus on what you can control. You can create a financial plan and stress test it. This is kind of one of the easiest ways for you to think about your interaction with the stock market long-term. And just why are you invested in the stock market? How much exposure should you have? And how does your exposure do over long-term? Focus on what I said, that kind of risk tolerance and goals. Line those up and you will, one, have enough cash for your lifestyle. Two, you'll be able to kind of enjoy your lifestyle. And then three, you'll have peace of mind. Focus on the long term. Be careful about projecting. Be careful about hating asset classes. And then also rethink your allocations. And if we don't know each other, if we haven't gotten to know each other yet, certainly I'd love to chat with you. You can email us at info@summithillwealth.com if you'd like to see a copy of these slides, or if you just want to talk about any of these things, happy to chat with you and just learn more about what you're looking for. If you are a client, thank you for your business and also happy to answer any questions you may have. Again, I'm Eric Walters, Managing Partner at Summit Hill Wealth Management, and appreciate your time. Thank you.